Good morning, everyone. Okay. I hope you can hear me. I'm assuming the microphone is attached to some speaker somewhere, possibly online, but I don't know. I'd like to welcome you to the National Institute this morning. My name is Stephen Millard. I'm the Deputy Director here for Macroeconomic Modelling and Forecasting, and it's a real pleasure, actually, to be hosting this event. The event's been organised by the Productivity Commission. The Productivity Commission was established by us here at the National Institute, together with the Productivity Institute, using funding from the ESRC, with a remit to examine the UK's productivity performance and provide policy solutions to address shortfalls in productivity. In the first year of the Commission, 2022, the name of the game was more or less collecting the evidence. What do we know about productivity at the sectoral, regional, aggregate levels? And then there was one session on some possible policy solutions. Now, something that came out of that was that not quite a smoking gun, but almost a culprit of UK's poor productivity is the lack of business and public investment in this country. Business and public investment in the 2010s in the UK was low relative to their historical averages, and were also low relative to other countries. So in 2023, the Commission concentrated on gathering evidence on investment. In addition to that, we commissioned Catherine and Paul to write us a couple of papers around this topic. And that's what's given rise to this morning's event, investing for growth, boosting productivity through higher public and private investment. Now, they're each going to present their papers in a minute, 25 minutes each for the presentation, and then we have a discussant who's going to talk about the paper for 15 minutes. The first paper we're going to hear today is going to be presented by Catherine. Catherine's paper on UK business investment, economists, managers, and financiers. Catherine probably needs no introduction, but I'm going to try and introduce her anyway. She's an external member of the Monetary Policy Committee of the Bank of England, has been since September of 2021. She is a professor of practice at Brandeis University, a member of the Council on Foreign Relations, and the American Economic Association, among others. She was previously the global chief economist at Citibank and the chief economist and G20 finance deputy at the OECD. Catherine has a PhD from the Massachusetts Institute of Technology. Her paper will be discussed by Sir Anton Muscatelli, Principal and Vice Chancellor of the University of Glasgow. On that note, I think I'm going to hand over to Catherine. Catherine.
Well, it's great to be here. I enjoy doing work with NIESR and with the Productivity Institute. So I'm going to talk about this topic, U.S. business investment from the lens pulling together economists, managers, and financiers. As you see, it's going to be an integrated framework to analyze past and consider research for the future. I think it's important to position this work between other work that was commissioned by NIESR and the Productivity Institute that looked at data, which Stephen talked about, and policy, which Paul is going to talk about later. It's important to position this in the middle because I am not going to talk about policy, because many of those policies may be the ones that are intersect with my current position. However, of course, with my OECD economist hat on, it's not like I've never seen policy recommendations before. So, sizing up the UK investment, which I'll show you one picture about, is based on productivity research. What I will do in this paper is All right. Okay, so what this paper is going to do is present a framework that pulls together what we know and what we need to know about the relationship between the way economists think about investment, the way managers think about it, and the way financiers. So I'm going to distill and synthesize the research that's out there, a subset of the research, of course, since it's all voluminous. I will focus primarily on UK research, but there's other on economic research that might be relevant. And then I pull out of that some research opportunities, and then Paul is going to take it from there after some comments on the paper. So let's first identify, and this just takes from the paper that was written on behalf of the Productivity Institute on sizing up UK investment. So UK investment has underperformed and business investment has trended down. The black line in the left-hand panel, and you can see it's kind of from 1980. So there's a long stretch here where we're looking at the ratio of investment, gross fixed capital formation to GDP, and the UK in black is at the bottom for the entire period, essentially. Within that, business investment, the green line in the right-hand panel, again, as a share of GDP, is showing this trend that is potentially a concern, or I would say arguably is definitely a concern. Now, the Productivity Institute, by name, productivity, and you might say, well, why look at business investment? Well, from a bottom line perspective, productivity and business investment go hand in hand. Productivity is changes in process, product, and innovation, and you need capital investment of one sort or another to do all of those. If you're looking at labor productivity, you need to think about the marriage between capital and labor. So essentially, at the bottom line of productivity, whether we're talking about TFP or labor productivity, you've got to have something happening with capital. I'm going to focus on business investment, although for sure, public investment is an important ingredient as well. And we can look about the complementarity between the two of those, but I'm not going to do that today. So let's first present this framework for analysis that we're going to be using as the lens to synthesize and distill the research. So it's a Venn diagram. It's pretty simple. There's an economic equation. I'm going to show it to you in a minute that will kind of identify the way economists think about the decision to invest. What are the criteria? What do they look at? What would you include in a regression, for example? Managers, however, are the ones who are actually going to make the decision. They are the ones who are going to evaluate opportunities from both the standpoint of return, from the standpoint of what they have to undertake in order to do this project, and they're ultimately going to make a decision. The question is, what are the criteria that are underpinning the manager decision, and does it overlap with the way economists think about it? Now, of course, financiers, and I'm not using the word investor here only because it confuses investment, investor, and so forth. So I'm calling the investment community, institutional investors, banks, and even internal finance, retained earnings within the balance sheet of the firm, as financiers. Ultimately, projects have to be paid for. You have to either use internal sources of funds, cash flow, or you need to borrow from a bank, friends and family, investor community. So when we think about these three different elements, it is the intersection of these three Venn diagrams that will create an investable and undertaken investment opportunity or project. But that's not the only story here, because I have two arrows that go down here. One is we can have an economic relationship, manager undertaking a decision to undertake a particular use of funds, and it can be financed, say, for bonds. Now, does that go into what I call in red real investment, meaning business investment that generates, I would argue, relatively more immediate returns to the company and to society? tangible and intangible being the two major categories. Yes, I could talk about real estate and go on underneath those, but those are the two that I'm going to focus on. Or that internal use of funds, the corporate bond, borrowing, the decision on the part of managers, that can be used for financial investment. In other words, used for undertaking mergers and acquisitions, used to undertake stock buybacks, pay dividends, or just to hold as a cash buffer. The implications, and we can see this in one of the papers that I'll be presenting, the implications for business investment matters how the funds are deployed. So there is a difference both at the individual firm level, but also we could discuss more broadly, and there's more work to be done here, on how the differences between the decision to undertake real investment to undertake it and to finance it yields different outcomes for, in a macroeconomic sense, than the similar decision to deploy funds for financial investment. So that's my framework, and that's the lens through which I'm going to be presenting a variety of research. So here is the economist business investment equation. It's something that I think we have all seen before. The present discounted value of a future stream of earnings, if it is positive, then and greater than the cost of finance, then financing that project, then it will be undertaken. The problem with this equation, which looks very simple, is that when we take it to reality, there's a lot of factors that we think of as being important in the economic environment, in the manager's environment, and in the financier's environment that might affect each one of those variables. So cash flows, how do those get calculated? I mean, they're future, they're not current. How do they get calculated? Who calculates them? On what basis? What are the characteristics of the economic environment? Does market competition matter? Of course it does. Global markets matter. Yeah, indeed. Okay, number two, discount rate. Who's going to calculate that? On what basis? We know that there are some ex post calculations that show up if we look at the balance sheet of firms, but there are also some ex ante ways of thinking about the discount rate that will be very important in determining whether or not a project is undertaken. Now, horizon, which is the number of N's, you know, again, whose horizon? Who gets to decide what the horizon is over which the discounting will take place? That's a question. And then each one of these elements has a lot of uncertainty, different kinds of uncertainty, and we'll see that that matters as well. TIA, there's always an alternative use of funds. And so whenever we think about this equation, we always have to have in the back of our mind, there is another thing that a manager, a financier could do with the money. Okay, financiers, who are they? Their decision, they have to finance business investment or alternatives to business investment, M&A, buyback, etc. So if you're a bank, you're looking at debt, and so you need to consider the value of the thing that you're financing. You have to put a credit spread on it, depending on the riskiness of the firm that you are thinking of lending money to. And then, of course, you have to include probability of default. If you're a equity market type of investor, financier, then you're using the capital asset pricing model in order to evaluate whether or not this particular investment is going to return sufficient to make sense to do the investment, or to shall we say, do a buyback or issue new equity. So the way I think that we need to consider this in terms of financiers is we need to look at the value of the financial exposure that either a bank or an equity investor or venture capitalist, we can think about that, relative to the economist's cash flow. So the economist's cash flow is the benchmark, I think, because I'm an economist, so I think of it as a benchmark. But so it's relative to the economist's cash flow, which, as I said, is still uncertain as to exactly where that comes from. So I think a key question is, who has the information to do the valuation of the investment that might be undertaken by the manager. Who knows that, right? Does the financier know it? Does the manager know it? Who knows it better? Now, the expected return has to be compared to the cost of funds of the financier. That's where risk premium and credit spreads come in. But we also have to consider that relative to the rest of the alternatives, whether it be a buyback, cash buffer, etc. Horizons, we can do the same sort of question mark. And then the one aspect of this that I think is important to consider, because we're going to see it's important for the data in the data for the UK. Now, the financier can either be this passive intermediary that sort of waits for good projects to come by and then decides whether or not they should be financed according to these two different equations, depending on who they are. That's passive. Or we can think of the financier as the ultimate beneficial owner. In other words, the financier acts as the owner of the firm and may see into management as the owner of the firm to a much greater degree than would a passive financier. And horizons, obviously, we can measure that again. Alternative use of funds, always out there. All right. Now, if you're a manager, so raise your hand if you have an MBA. I should have asked this for the finance people. Okay. This is you. So managers' decision to undertake business investment. So they're looking at revenues, or they're looking at earnings, or they're looking at returns. We need to know kind of what they're looking at. Now, managers have inside information more than the other two players that I've just mentioned. They probably have more information. And they also provide that, but not completely, to the rest of the to the potential investor public. What kind of uncertainty or what might they care about in terms of the market, prices versus quantities, market characteristics versus market size? What are they measuring against? Earnings before interest and tax. But they might also care about these other things, about which there's a lot of regulatory issues, regulatory accounting, and so forth. Cost of capital. Cost of capital is a pretty broad term, right? We think we know what it is, but I have 4 different measures of the cost of capital. There's the discount rate or the policy rate. That's me. Nobody gets to borrow it back, right? Basically, overnight. There's always a yield curve. There's the weighted average cost of capital, which looks at the liability structure on the balance sheet of the firm. That's ex post. We can kind of see it. We have return on invested capital, which is a different concept. Again, we can pull that off the balance sheet of the firm. It's ex post. But this last one, the hurdle rate, that is actually the most important factor when thinking about whether a manager is or is not going to make a decision to undertake an investment, and that is ex ante. That's a ex ante decision, not the ex post is what we see what happened and how it got financed, etc. Ex ante, they decide whether to do it or not, and I will show some interesting conclusions about hurdle rates. And of course, there's deltas, there's gaps between each one of these that is also important. Again, horizons, manager characteristics. Are you facing an incentive compensation plan where you're going to get a big bonus if you just cut your R&D by a little bit so that you can make your numbers, especially the guidance that you just gave the financiers a quarter ago? Yeah, you're going to do that, and it might have implications. All right, so let's look now at some of the empirical work. There's a lot in the paper. Obviously, I'm not going to tell you all about it, but I'm going to give you a couple of points. When do I have to just? Okay. All right, so this is a basic benchmark model for UK investment. It's an IMF paper published in 2023, and it's the basic, vanilla way that economists approach this. So investment is a function of market growth. That's in the green, sales growth. It's a positive function of the returns that you got last period, which is the top of the yellow. Effective interest rate doesn't matter. So what matters is the return on invested assets, not the interest rate. Even though there's a negative sign there, it's not significant. What does the structure of financing, how does that map? Well, if you have a lot of retained earnings, in other words, you're profitable, you're throwing off a lot of cash, you will use that for business investment. That's the top of the purple area. And if you can undertake long-term debt to capital, in other words, you can finance undertaking debt, that is significant, but you can see that the coefficient is smaller. So retained earnings matter more than your ability to borrow. Now I've got the bottom two dummy variables in there. This is not my research. I will not be presenting any research at all. I'm only presenting other people's research that I have distilled and synthesized in this paper. But I do think it's important that we note that there are two dummy variables here, both of them significant in terms of deleterious impact on business investment, Brexit and COVID. Now, I said that business investment competes with financial investment, that was those two different arrows that went down from the intersection of the three then in the diagram. And this is a paper that looks at this question in the context of UK firms. Now, I should say, all of the work that I'm going to be showing you here uses firm level data. We care about the macroeconomic outcome of how much investment there is, what its implication might be for GDP, for supply side of the economy, living standards, all that macro stuff we care about intently. The only way we do research these days is micro foundations. So it's all using firm level data, all of it. And we can aggregate it up, but we have to use firm level data in order to test these hypotheses that are really at the front line of our trying to understand the challenges facing firms and financiers in their business investment. So the first top set of rows here are talking about operating profits minus dividends. So this is what you're actually earning, and you're not giving any of it up to anybody else. So the real activities of the firm that are being undertaken positively correlated with business investment. Again, sales over capital. So again, you're running a positive market. You're expanding. Got good sales. These are all real activities. They are positively associated with business investment at the firm level. The interest matters in this case. Interest paid and dividends. Both of them are drags. This second bar. Both of these are drags on business investment. So slightly different conclusion than the previous paper in terms of the interest component, negatively correlated and significant. So these are things that we want to be looking at when we do work in the future. The bottom set of rows in the red, these are financial activities. Financial assets as a share of the capital stock at the firm, negatively correlated with business investment. Non-operating profits, in other words, if you're a financial subsidiary, for example, that is a drag on the activities for business investment for the firm. So there is this trade-off internal to the firm that we can identify in terms of business versus financial investment. More work to be done here, but I do think it raises a flag as to wanting to understand what's inside the firm. So what's missing from the UK benchmark models is, and this is a very long paper, Gutierrez and Philippon using US data. I've got a box here looking at issues relating to governance. In other words, institutional ownership. That's the bottom set of check marks there that's saying it's significant in their regression. And competition, degree of competition in the marketplace, which also is significant in US data. Is it going to be significant in the UK? I don't know. Nobody's looked. This is something we have to do. Okay, types of market uncertainty. I think I'll skip this one in the case of it matters whether uncertainty is in the form of price volatility or market access and market volatility. What matters for investment is market volatility. In other words, the size of your market, how it changes, volumes of production. Prices do not see, price volatility and price variation does not seem to be as important. But that was with European EA data, and we'll have to look for the UK. I don't know. So let's now look at the cost of capital. So I want to look at the cost of capital and show you some data for the UK. This is from work that was done at the Bank of England back in 2017 and 2018. It is time to look again. And the left-hand panel gives you different measures of the rate of return on capital. There's bank rate, which is the blue line. Okay, well, you know, back then there was the effective lower bound and so forth. But then you can look at a different set of variables after that. The average cost of loans for private non-financial corps, that's the next purple line. There's the weighted average cost of capital, which is the blue line. Rate of return, that is in the green line. Which one of these should we be using? Which ones do financiers using? Which ones do managers use? They're really different. And at least, you know, but prior to the effective lower bound period, there was, and even afterwards, there's a lot of variation. Okay, the second chart on the right-hand side says that these numbers that you see on the left have a lot of variation across firms. So the distribution of hurdle rates is very different. So we need to understand what the hurdle rate is and the distribution of hurdle rates, because it's clearly not the same for all companies. And so then we can look at the extent to which different cost of capital measures affect UK investment outcomes. And so weighted average cost of capital, so one standard deviation change in weighted average cost of capital doesn't affect business investment very much. On the other hand, a one standard deviation in the hurdle rate, which I just showed you is different, is fairly significant. And then the last one, we can look, hurdle rate premium is above additional risk premium that managers may choose ex ante to apply to a particular project because they think it's risky. And then the last one is actually stock price uncertainty. It's not market uncertainty. And that also has a very significant effect on business investment. More to be done here, trying to understand which cost of capital measure really is the driving one, and it's probably going to be different across different firms. Okay, managers. I'm going to talk about managers just for a minute. I'm going to argue, and these are data from the OECD, large stable multinationals dominate UK investment. They account for about 50% of UK firms account for 50% of business investment. That's in the red line. It also accounts for 2% of value added and employers. Looking at the chart on the right, that 50% is multinationals, principally multinationals, which is the yellow bar. So understanding the difference between the 50% multinationals and the 50% that are not multinationals is a pretty important lens to consider, because we think they're different economically, they have different management, and nobody's looked at this question. It's important to look at. All right, what about managers themselves? Let's just, the left-hand side is a little bit complex. This is ONS data, all of the references you can see here. On the right-hand side, this is management practices by firm size. If we have a lot of small firms, they tend not to have great management practices. How does that relate to business investment? I don't know. Nobody's looked at it, but it's pretty important given that managers ultimately are making the decision whether to undertake a project or not. I'll leave that one. I will leave that one. I got to show, well, no. Financiers. Basically, taxes, super important. Both domestic firms and multinationals don't report any profits. So we'll have to discuss that in more detail. Let's see, last group, financiers. The reason why I want to bring this one up is UK financiers are concentrated. They are institutional and they're foreign. Okay, So this is, again, OECD data looking at ownership by investor category for the United Kingdom. That gray bar, institutional investors, and the bar down below, most of them are foreign. In terms of additional form of concentration, in the panel on the right, 22.6% of UK firms are owned, concentrated by the top 3 institutional investors. So there's both concentration by institutional investors as well as within firm concentration by investor. As far as I can tell, nobody has used these data to try to understand the investor's role in the decision to undertake business investment. So there's a lot of results for US data, which is why I think we should look at it. But let me just conclude the research opportunities. Investment concentration 2 ways. I just said what the 2 ways were. Understanding product market, and I really think that we need to do a lot more work on looking at size distribution, domestic and versus foreign. It's a very important issue in the UK. It's a research opportunity to be undertaken. Understanding product market dynamics, competition and concentration. Again, not really been looked at, again, through the lens of domestic and foreign. Different kinds of uncertainty. There are papers in the report that identify there are the real uncertainty, in other words, macroeconomic uncertainty or market uncertainty, financial uncertainty, stock price variation and so forth. And a lot of policy uncertainty matters for business investment. And then this last set of issue on cost of capital, I've tried to identify just why I think that understanding cost of capital and how it is related to firm size, firm ownership, and how that intersects with manager characteristics, taxes, and other regulatory environment as key elements of understanding the business investment outcome in the UK. Thank you.
Thank you, Catherine. To discuss Catherine's paper, Sir Anton Muscatelli. Thank you.
Should I use the microphone? Do you think it might be? You want me to use this, or is the lapel mic okay? Okay. Why don't I use it just in case the lapel mic doesn't work? Look, I'll try and keep this relatively brief because actually I find this quite a difficult task, partly because, as I said to Catherine, I pretty much agree with a lot of the research agenda she's set herself in the paper. It's a real pleasure to be here to do this. I think Catherine provides a really useful survey of some of the most recent evidence on drivers of investment and really the framework that she's proposed for future research, looking at these 3 different perspectives from the economic side, the management side, and the financial side. I think are going to lead to important work, I think, in trying to understand the specific issues which the UK faces. And actually, just let me emphasize one point which Catherine made at the start. There's a lot of evidence which shows that actually one of the big problems the UK faces in terms of productivity is through the TFP channel, and that capital deepening is only part of the story. But because of the complexity of how investment can affect TFP, actually total factor productivity, as you mentioned, you can't ignore this. And and the evidence is so compelling. She showed the chart of the paper from Alayande and Darren Coyle. I mean, the UK is very much at the bottom of the pile in terms of G7 and business investment, and the trends, are there for everyone to see. And actually, even if you look beyond the G7, if you look at the OECD data and the latest OECD report on business investment, and the data on that goes up to 2021 across countries, the UK is 4th bottom of the so it's pretty stark. So let me come to Catherine's paper. As I say, I don't disagree with the research agenda. I think a lot of these avenues of research are going to be really important. So I'm going to just make three points, which hopefully are complementary to what Catherine is saying in her paper. And as I say, I do believe that delving deeper into the factors affecting the economist model of firm level investment, but also the real world imperfections introduced by the presence of managers and financiers matters quite a bit. My first point is really, how do you operationalize all this if you're trying to trying to sift through this data, these different channels in future empirical work, especially if one starts from the premise that Catherine argues they're all at work. And the problem that we face in understanding the UK's investment problem is that there are so many different drivers in play that are all happening at once. So even before we bring in the financing channels and the drivers of the wedges between the cost of capital and the return on investment and issues such as the ex-ante hurdle rate, the exogenous factors, any exogenous shocks will actually play through all these three perspectives. And it's of course not a coincidence, and Catherine showed this, that the UK has faced other issues. One of them, which she didn't mention today, but she mentions in the paper, is that the UK is one that faces the most regional disparities, certainly in OECD countries, and that this is probably part of the story, as the Productivity Commission highlighted. But as you mentioned, one of the studies, the one by Carella and others at the IMF, shows that Brexit is a very significant factor. So these are not spurious coincidences, these are the factors. So the problem is, if you have these shocks, whether it's a Brexit shock or whether it's some other uncertainty shock, it's going to feed through all these three different channels. And there's a real issue around identification, what economists call identification, and trying to understand the causal links at play. So for instance, let's take the greater uncertainty caused by even the anticipation of the Brexit referendum, even before 2016. And indeed, subsequently, and I can say this because I'm not a policymaker, the subsequent desperately bad execution of the Brexit project. That's going to affect the model both through the economist channel, through the cash flow channel, but it will also impact pretty much on the other channels, driving the wedges, which, as Catherine says, determines decision-making by both managers and financiers. Now, there might be interesting survey data, and Catherine shared some of that on the ex-ante hurdle rate, on what that greater uncertainty did at particular points in time to the hurdle rates, the short-termism, to information gathering that she mentions in the paper. But ultimately, this is really going to be a complication in empirical work, because if you really want to understand which of those channels is the most important, you're going to face a real area of identification, challenges around identification. One possible way forward here to try and appreciate how important these different channels might be actually to develop the theoretical model, the theoretical framework, as she sets out, and actually do some calibration analysis on just how important they're likely to be relative to each other. And as Catherine notes in her conclusion, I think a very good starting point might be to focus on the cost of capital and whether we can get a better understanding of the size and entity of these dynamic wedges between the weighted average cost of capital, the return on invested capital, and the top-down hurdle rates. How these concepts are affected by variables like firm size, ownership, financial ownership or / financial ownership, tax factors, management quality, etc. And that then might give you an initial perspective on the importance of these different wedges, how they've changed over time, how they might explain some of those trends in UK business investment. My second point, my second comment is that, especially post the great financial crisis, it might be useful to focus on the complementary role of public investment. And that's something we haven't touched on yet. We know from the Productivity Institute that this is a potentially important crowding in channel for private investment. We also know that from OECD data that the UK does poorly in this category of investment. We're bottom of the league, not only in terms of private investment, we're bottom of the league in terms of public investment, certainly since the great financial crisis. And indeed, the study, the slide that Catherine put up from the study by NIESR Carella, Ruer Chen, and Xiaobo Shao from the IMF actually has a cross-country analysis with fixed effects, which shows that actually a highly significant variable is that crowding in effect from public investment. And it's probably one of the most significant variables in their fixed effects regression. So in policy terms, and I know Paul's going to go on to talk about this, I think this matters because we know that these kind of investments by the public sector, especially on infrastructure or key assets, can make a huge difference in terms of providing certainty, reducing uncertainty for investment, particularly over a crucial period of time. And we know, for instance, around the US Inflation Reduction Act, anecdotally, this is beginning to have a real impact in terms of crowding in private investment in the recent experience of the US. So really trying to analyze that and bring that in, I think, is important. And perhaps I'm oversimplifying this. And of course, the impact of public spending on the cost of government financing works in the other direction, and you have to be careful there. But if there are crowding in effects, I think it would be really interesting to see how they operate at different sectoral levels or at different firm levels. If one compare the UK, for instance, not only with the US, but some of the other OECD countries, many of the other European countries, where public investment has been more significant, we might see whether it just operates through the economic channel, which is, but also, the other channels identified by Catherine, the financial and manager one as well. Finally, my third and final point is that I agree with Catherine that one of the most interesting areas for further investigation is the role of competition and concentration in the firm marketplace and investment performance. And indeed, as she said, if you read the US literature, look at the work of Gutierrez and Philippon, this seems to be a highly significant effect. And it would be interesting to see whether, in fact, the UK is actually in an awkward position, because it might be, it has this higher concentration of how financiers decide because of that institutional concentration. And in that sense, we're close to the US. But in many other respects, actually, we don't have the same scale and entity of the US financial market. So we might be in exactly the wrong place. We don't have the ownership structure of many European countries. We don't have the same kind of financing structure. But we're very like the US, but unfortunately, we don't have the same side of scale and scope of financial markets. So overall, Catherine, really interesting paper. Thank you. I agree with the framework. I think there are some angles where I think in order to understand these three different perspectives, the management, the manager, the financier, and the economist, I think we probably need to look at one or two more details, see how important they are relative to each other. But thank you.
Thank you. There will be plenty of time for questions when all the speakers have finished. So do hold your questions. Think of some good questions to put to Catherine and Anton later. We're going to move on, though, to the second presentation, which is Paul Fisher, who's going to talk about productivity and investment time to manage the project of renewal. Paul is currently the chair of the London Bullion Market Association. He's a non-executive director of the Debt Management Office, a senior research fellow at King's College London, and visiting professor at the London Institute of Banking and Finance, the Warwick Business School, and Richmond, the American International University in London. I thought I was hogging visiting professorships, two of them, but Paul has beaten me on that one. Prior to that, he was the executive director of markets at the Bank of England and a member of the Bank of England's Monetary Policy Committee between 2009 and 2014. Paul, thank you.
Thank you, Stephen. Well, good morning, everybody. Nice to see so many of you here. I hope you can hear me at the back. If you can't, then wave a hand and I'll use the mic. And for anyone who wants to cite me for anything, King's College is the right one for this topic. Okay. I wear lots of different hats, and I certainly wouldn't want my board positions to be used in any way related to economics. Right. A few thanks. Thanks, first of all, for coming along to this session this morning. It's very much appreciated. I know your time is valuable. I hope you get some insights from it. And if anybody wants to follow up with me on some of these topics afterwards, hopefully I am very free to do so over the coming weeks. Thanks to the Institute for asking me to write this paper and for not complaining when I produced a paper which wasn't quite what they wanted and wasn't quite what I was expecting, but they actually liked it and have encouraged it rather than the reverse. So this is a topic I've been thinking about for quite some time. I've come at it from a slightly different perspective, though. The thing that's been bugging me is the question, what is the sustainable growth rate going forwards? Given climate change, given the transition to net zero, that's actually been what I've been thinking about. I haven't quite got the answer to that yet, but it's given me a way into looking at this, which may be different. So this first slide, I haven't got that many slides. I've just got 4 of the 5 charts in the paper and a few summary slides. So hopefully we can just talk around it. UK productivity growth has clearly slowed visibly since the great financial crisis, and UK's underperformed. That much everybody agrees, as far as I can see. It doesn't be any doubt about that. If you look internationally, productivity growth has been slowing for longer. I think that is generally agreed. But as far as I can see, there is no academic consensus as to why this has happened. And I went and read 60-odd papers submitted to the Productivity Commission. I've read a lot more besides that. Everybody I've asked about this, nobody has even, apart from what I'm going to talk about, which somebody else has also proposed, nobody has come up even with a suggestion that there is one explanation for why this has happened. What you look at, there's a lot of good papers being written, I should say, by a lot of smart people that have some very important results and some very good content. A lot of it for me is allocating this outcome to different bits of the economy, different regions, different. You can say it is weak investment, or you can say it's weak total effective productivity growth. Actually, both of them weak, but that sort of covers everything. It just relocates the question in a different place. It doesn't actually say what. So it's the what rather than the why. And what I want to know is why. Because if you don't know why this has happened, the risk is you come up with the wrong policy. And if you start allocating capital to the wrong uses, you end up making the problem worse. I was trying to think of an analogy. I was thinking like the old practice in the medical profession of bloodletting. Right? Probably kills more patients than it helps because you don't know what's going wrong at the start of it. We've got to find a way of it. I'm going to challenge some of the received wisdom on how to think about this in the process. Because if you don't have the understanding, you're not going to be able to restore growth. You may actually make things worse. So we need to try and get on the same page. Now, what is this paper? It is a policy paper. It draws on economics, but there's no maths. I think it's reasonably accessible. I hope you like to read it and dip into it. There's lots in there. I'm not going to be able to cover anything like the content of the paper in this short session. I'm going to focus just on the key bits. It is not intended to be party political. This is an election year. You can't talk about growth, productivity, output without it being political in some way. I am trying to be agnostic on party political things. I think whatever your ideology is, you could take the results away and run with them in a different direction. What's here is my own view. Apologies for that. It's almost inevitable that if you're commenting on what has happened, you've had one party in power for 10 years. Some criticism will naturally flow, but it's not meant to be party political. So this is a chart which summarizes the problem. This chart is based on what was produced in the first round of the Productivity Commission papers, except for the fact I've updated the data slightly. The data set comes from some French academics, Bergier et al. The data is available online and they keep it regularly updated. They've got lots of countries in the data set. Okay. Now this is really important and good work because collecting this data and trying to get it consistent is a real challenge, right? Productivity, this is real productivity. So you've got prices, you've got output, you've got labour hours all feeding into this. You've got different measurement systems, right? Our national accounts started after the Second World War. You've got data going back. When you compare across countries, you need an exchange rate, right? And this is in real time, so it's a real exchange rate, and they're using 2010 purchasing power parity exchange rates. That's an estimate, so big confidence interval goes around that on top of the uncertainty in the data. So the message is don't read too much in. There's probably huge confidence intervals around all these numbers. Okay, but it's still fantastic work that we've got this data and can use it. And it sort of shows all the things that people expect to see, which is this fantastic improvement in productivity for years and years and years and years until you get up to the start of the millennium. And then it all sort of tails off a bit. The UK was doing a bit better, then sort of goes in line with a bit during the 60s, and it starts to dip under, and up here it really goes wrong, right? And you get this huge gap emerging where we underperform. Now, I say this chart fits what most people expect to see, and it sort of plays into people's consciousness a bit. I think it's very misleading for three reasons. One is this thing about the uncertainty in the data going back. There should be huge confidence intervals. Secondly, you have to be very careful in these cross-country comparisons as to what's significant and what isn't. But the main thing is that this is a chart in levels. And I've been looking at some longer term charts for prices going back to the 1210s. You can't look at a chart in levels like this and read off of it growths and percentages, which is what you want to do. Because being in levels, it draws all your attention over here. 10% here is much bigger than 10% down here. The growth rate is not the slope of these lines because the growth rate is changing. So this is a misleading picture. It does show you the big historical events going on in the world, which it turns out matter quite a lot. So this is my revised version chart in logs, right? So 1% is 1% everywhere on the line. Those of you who've got the maths, fine. If you haven't, just take it that 1% is 1% wherever you are. And now you can read the growth rate off of the slope. So let's start with the US, which is often taken as the country which is closest to the productivity frontier. Rightly or wrongly, it is. And what you see here is this much steadier line. The peak in productivity growth is about the late 60s, early 70s. And this is a very smooth trend. It doesn't have a break point. Okay, so one of the problems we've got with photos is how come productivity clearly breaks around the great financial crisis, and yet we haven't got one explanation? Well, part of the answer is it wasn't a clear break. This has been happening for ages. And in case I don't get to it later, one of the things that happened in the UK, I think, is 5 or 6 years before the great financial crisis were an unsustainable demand-led boom, which you can see in what's happening to the current account. Just put that on one side, and that helps cover up what happens. This is actually a much smoother process. Germany and France badly hit by the Second World War. Long period of catch up, and of course, as they get close to the US, what happens is magically they go in line. Okay, the UK not quite so badly hit by the Second World War, sort of catches up, actually catches up quite well until about the 70s. We were badly hit during the 1970s with the oil price shocks, much worse than other countries, and then we had North Sea oil. Dutch disease kicked in, perversely it sort of goes a bit wrong. That's now further research why we didn't get a productivity boost from North Sea oil, because we thought oil was high productivity. Anyway, but this is again a very smooth picture. The differences now don't look so big. They're still significant, right? 10 to 15% productivity gap. But historically, this is not unusual. So why is this? Well, this is not because of anything that's happened up here. It's nothing to do with the European Union. It's nothing to do with which government's in power. This is a long-term trend. It's going to carry on. I think fundamentally it's to do with the structure of the economy as it industrializes. It's very, very simple. What you get is during this period, all these countries are heavily industrializing. Manufacturing is growing strongly. Manufacturing has a much higher productivity rate than other sectors taken together. Some service sectors have high productivity rates, but manufacturing is generally the highest. Manufacturing eventually reaches a peak. For a long time, it grows as a share of the economy, and it's employing more people. So it's very productive, but the increase in output is so big, you'll employ more people. Then you start to get a bit of a wall. The only way individual firms and sectors can be more productive over that period of time is to start to shed labour. Okay, and that's what happens. So just to give you a bit of context, the UK manufacturing was 30% of the economy in 1970. It's now under 10%. And actually the employment rate has also fallen about the same line, even though manufacturing output has gone up. So you start to shed labour, and then eventually manufacturing starts to fall as a share of value added, and it falls and falls and falls. And this has been happening in every industrialised country. Okay, so it's not surprising. This is just a batting average effect as manufacturing has slowed down. Now, does that make sense? Well, think about it. If you grew at 2% exponentially at a constant rate, you would double the economy every 36 years. And then you would double it again in the next 36 years, and then you would double it again. That was never going to be sustainable. Right? Yes, there isn't enough stuff on the planet to support constant exponential growth rate. This is basically an S-curve model of the sort you use for product diffusion, growth of the firm, all sorts of things. There's nothing complicated about it. It's just what's going to happen. And if you looked at developing countries, lo and behold, they're all slowing down. I can remember about 10 years ago, somebody said, oh, Chinese growth rate is falling below 10%. I said, well, of course it is. It's not going to carry on 10% for years. It couldn't. It would become an infinite size. So as the Chinese economy matures, of course the growth rate slows down. That's what happens. It's very, very simple. A chap called Vollrath has also come to this conclusion. And he actually talks, he goes further. I think it must be a bit, I haven't read all the book, but it must be a bit populist because he starts claiming it's a sign of success to have your economy slowing down. And bizarrely, it is. The UK was the first country to have an industrial revolution. It was one of the first to have deindustrialization. It's not surprising these problems have hit us more. Yes, there's still a gap, but we're not going to go back to growth rates like this. Right? We're not going to go back to having manufacturing being 30% of the economy. It's going to keep falling. And what I like to look at is agriculture. In 1600, 2/3 of the adult male population worked in agriculture. Now it's less than 1%. What happened? It became very productive, became very automated, lots of machines. The value added actually goes down over time and it becomes relative to the rest of the economy. And it's now a tiny part of the overall economy. Same is going to happen with manufacturing. It's just going to get smaller and smaller and smaller over time, slowly, hundreds of years, but it will get very small as a portion of the economy. This is the point at which to say, what is our investment strategy, government's investment strategy at the moment? It's to support plant, machinery, and IT spending. Well, a bit of IT spending maybe. Plant machinery, that's manufacturing, isn't it? Why are we focusing all our investment policy on supporting the bit of the economy that's going to be declining? Doesn't work. So we need to start thinking about other things. So here, why should productivity being slowed down? I think it's just simplest explanation, Occam's razor. You don't need to be too complicated. I've been looking for evidence which will refute this. I haven't yet found any. It makes quite a lot of predictions about what has been happening, which are consistent with what has been happening, but of course it would, because that's why I've proposed it. The real test would be, can you find something which is happening, which would not be true if this were true? We're going through from agriculture, manufacturing to services to digital services, and for some reason, which we'll come on to, services and digital services just don't have the same productivity growth as manufacturing, at least in the way we measure it. And there's quite a lot of measurement problems going on here about how we measure productivity in services and digital services in particular, because we base everything off the national accounts, which is heavily based on monetary estimates. And there's a lot of improvements in living standards going on, which are not being monetized. And so we get these measures of low productivity, even when I think the productivity of life is booming away in an unmeasured way. So this is all fairly standard stuff. And you can just think about this in firms. Happens in a lot of industry, coal mines. God, in 1920, there was something like 800,000 plus working in mining in America, coal mining. Now there's about 55,000, peaked, it topped off about 40,000. But it's just, but all those jobs get replaced in other sectors. So as one sector sheds jobs, they all shift somewhere else. And that's partly why productivity ends up going downwards. So I don't think there's anything else on there. Yeah, just got some numbers on the bottom there. Manufacturing products fall to 1/3 of its peak over time. I actually realised that in all my extended family, I didn't know anybody who worked in manufacturing. Nobody. Everybody was in services or construction, right? Because construction is about the same size as manufacturing. So does this matter? I'll just go back to this point about what has been happening more recently. You see, this is an output chart, right? It's GDP rather than productivity. You get a lot of charts which do this. They take the peak just before the crisis and they say, oh, if only growth had carried on at the previous period, you get this way up here. We've got this huge gap. Why isn't it closing up? Because it's complete nonsense. I say what happened during this period here is we thought there had been a supply side revolution. Okay, there hadn't been. We had a big boost in government expenditure. The Monetary Policy Committee, which I will take. Yeah, the Great Crash. We had the highest interest rates in the G7 for most of that period, so we did not get any domestic inflation, which is what you would otherwise expected. What happened was it all went into the external imbalance, and the current account deficit went from broadly imbalance back here to 4% or so of GDP. By the time you get to the crisis. Okay, that big current account, lots of capital inflows, where did they go? Into our banking system, which helped cause the financial crisis, right? It all adds up. But you can't start any projection from 2007. So any chart you see projecting productivity, output, or anything else from 2007, my view would be wrong. You start back here, take that same trend and start back here, 2002, actually you get a much more realistic picture of what the output gap might look like. Still got one. But given that the output growth is actually slowing down, even that's probably not right. I've just fitted an arbitrary trend here from there to through here, which may actually be more like the truth. Growth has slowed down, and these charts actually prove nothing. Right? What you can't do, though, is if you're looking any sort of cyclical analysis, you don't start at a peak. You should start at a cyclically neutral point. And as far as I can tell, back here, sort of 2000 to 2002 should be it. That's a methodological point. But it explains some of the things you see in some of the papers I've read. This is productivity, going back to productivity using the same data set. I just wanted, again, you get this period, here I've sort of put in this, an overestimate of the trend deliberately, because that's the sort of thing you see. It goes through 2007 using the previous growth rate compared with what's happening now. But interestingly, I've just put the US path and put it on top. And two interesting things. If you just do that from the immediate end of the Great Financial Crisis, you do get this gap between the UK and US. And what happened is, in the financial crisis, the US basically sacked a lot of people, and we didn't. In the UK, firms hoarded labour. Shakeout versus hoarding. The same, interestingly, happened during COVID. The Americans had a big shakeout to improve their productivity. We hoarded labour. And that seems to persist. And I think this is a separate research issue which is worth investigating. Why did UK firms do one thing? Why did US firms do another? And why did that effect seem to persist? You would have thought the two things would have worn off and come back together over time, but they didn't. But actually, if you do this from 2010, I think it was, 9, look at that productivity path for the country on the productivity frontier was very similar to the UK's until you get to COVID, when it's opened up again. So we are not so different from the US, is my conclusion from this. We may like to think we're so terrible, and we have done worse. Let's be clear, there is a big difference, there is a productivity gap, but the same things that are affecting us are also affecting the US. And in fact, all these culture wars, the big political divides in America, quite a few of the other events we've witnessed, I think, are being caused by the underlying slowdown in productivity growth output, which is affecting manufacturing jobs, rather than the politicians. This is affecting the politics of it. So the productivity interest slowdown has been an underlying process for a long time, maybe 50 years. I'm slightly, I've put that forward as a possibility. My root cause is most likely just the natural revision, but it's not going to go back. Right? We are not going to reverse to the type of economy we used to have. It's going to go forwards. We have slowed most. You could say we're ahead of on this problem rather than behind. It doesn't help us. We could push back a little bit. There's things we could do to improve this and close that gap. Whether you want to or not, I don't think I want to live in the United States. Thank you very much. Homicide rate 4.5 times that of the UK. Inequality over here. The health system, fine if you're rich, not really good if you're not rich. Lots of things about it. But we could. There's things we could do to be a bit more productive. A lot of events have been seeing a reaction to this, I think, because the economics always gets you in the end. Constant exponential growth never lost. Just note, since 1994, the UK economy, in terms of GDP, has actually doubled in size. Doubled since 1994. Nearly all of that up to 2007, right? And then it's all been flat. You can't keep doubling the economy every 30 years. Not going to happen. So it's not, it's bad, but people say, oh, this is the worst it's ever been. Well, compared with when, I think back 20 or 30 years, and I see output per head and living standards being much lower. But it's not what, if I read some of your papers, it's not what I get. Isn't this all awful? Now, I should say I'm not part of the anti-growth coalition. I want growth to be as strong as possible because that's what drives living standards. But we have to be realistic. If we try and drive growth faster than the economy can grow, we'll end up in a mess. A demand boom is definitely not the answer, right? If you try and grow demand faster than supply, you'll end up in the wrong. Part of the problem is GDP is an increasingly bad measure of welfare, well-being, utility. Lots of things are happening. If you think about what's happened, even since 2008, when Facebook came along, people have now got smartphones. 92%, I think it is, numbers in the paper, people now have smartphones. 80% of the over 65s have a smartphone. That's going, and even that's not quite up to date. It's going to be higher and bigger than that. People's lives have been changing enormously. all sorts of network benefits kicking in, but a lot of it isn't monetized. People are busy posting things online, reading things online for no change in money. Life is an awful lot easier in many respects. If you use a smartphone, you can get access to information, to entertainment, all sorts of things. A lot of that just isn't being recognized. So I don't think GDP is properly recognizing what's happening to living standards. Unemployment rates are not low. There's a lot of people choosing not to work or unable to work, and we could do something about that. It does create a problem for the fiscal position. We'll come back to that. And inequality has become more visible and more political because of this. And that's a separate discussion. So what should we do? Most must look forward at the economic structure. We've got to take the economy as it is, as it's going to be, and focus our investment policy on supporting that, not the things we used to do. We need to rethink what productivity means in terms of the service sector and the digital economy. It is not going to be investment in plant and machinery that drive productivity in these other sectors. What is it? It's going to be people. If you're in the services sector, most of the investment is in people. Now, that doesn't even count as gross domestic fixed capital formation. It's not in the investment numbers. But if you're in any sort of service, whether it's banking or restaurants or hairdressing, it's the investment in people that matters, and that's what we should be focusing on. So health and education actually become more important. And we have not been increasing spending on health and education as a share of GDP in the way which you would expect of a developed country. This is my non-political point. You could do that either by a private sector or public sector, right? We could be massively expanding health and education by encouraging more private sector provision. We aren't. You could do it by properly funding the public sector. We aren't. We've got this sort of passive response at the moment. We've been squeezing down on spending in these sectors. Well, this is arguably the most valuable part of the economy. We do need a better approach to large public projects. There's quite a lot in the paper about how we could organise things like that. We do think about different ways of raising taxes. I do think we need to be taxing social media platforms a lot more than we are, because they're generating a lot of negative externalities for the economy as well as all the positive stuff. That's the reason for taxation. We should be using that to police some of these platforms. And we need different ways to measure well-being, which properly reflect what's happening in the modern world. And these will be my priorities. First of all, we need to invest in the digitalisation of everything, including the health service, including education. COVID was a disaster in the school run because nobody had invested in educational provision online, which I do all the time in master's courses. They're all online. We need to invest in the transition to net zero, because if we don't, we're all dead anyway. And actually, this is the one thing, as a change of technology might generate some more growth and more productivity. It might. I'm not saying it would, but it might. So that's something worth looking at. And this is the question of what's the sustainable growth rate. We need to invest more in people's education, health, public or private. And we're going to, it's not really in the paper, we're going to need a new fiscal framework to try and manage this. So we'll stop there.
Thank you. Thank you, Paul. Lots of food for thought. To discuss Paul's paper, we have Rachel Lomax, who many of you will know as the ex-Deputy Governor of the Bank of England and a member of the FPC between 2003-2008. Rachel, over to you. I don't know, you can...
So I guess my background relative to the others is I'm a long-time policymaker, spent years and years in places like the Treasury and in government departments that try to set policy and manage public sector investment. And not a lot changes, I'm afraid. This sort of Groundhog Day feel to a lot of this debate. I really like Paul's paper. There's a lot in it. I encourage you to read it all. I'm probably going to talk about some bits he didn't talk so much about, but that's fine. I think the big story, if I can summarize it rather crudely, is quite a seductive one. You know, the UK slowdown in productivity growth goes back a long way. It's not out of line with the experience of other countries. It may be best thought of, and this is actually a sentence I didn't like, but I'm going to quote it just the same. as the natural and inevitable outcome of changing economic structure. I mean, that's the bit I think I want to quarrel with. I mean, I think, as he said in his remarks there, what he actually means by that is the shift to services over the last period, and imperfectly measured productivity in that sector as well. But we'll come to that in a minute. I think he's right. The macro data probably does understate the improvement in welfare associated with the latest internet-based technical revolution. And anyhow, as you also say in your paper, but didn't boast about it now, there's more to life than GDP. So rather than beating ourselves up about the supposed underperformance of the economy, an economy that's disappearing into history, we should focus on maximising the welfare benefits to society arising from the deployment of new technology. Government needs to think about the implications of this technology for the tax base and its own operations, and up its game in managing big projects and recognising the importance of health and education for economic well-being. So what's there to disagree with in all that? Well, not an awful lot. I do want to just gloss what you say about the mature economies tending to slow down. Say a word about where I think the slowdown, the breaks into a mature economy are located, which are more relevant going forward than the problems about service sector productivity and measurement. And secondly, I do want to, given my background, focus on some of the more practical questions of how government can best support productivity and necessary investments. And I do want to say a few words about something you didn't mention at all in your opening remarks, which is infrastructure, which I honestly think is hugely important. So on the first question, I think as we talk about the past, it's important to remember that we've been living in the last 30 years through an amazing period in global economic growth. It's been incredibly dynamic. It's been the rise of China and the rest, huge increase in global specialization, development of global supply chains, increased migration, and of course the digital revolution. And all this has facilitated spectacular increase in effective global labor supply, as well as major advances in the productivity frontier in agriculture, the extractive industries, and manufacturing, and maybe on the cusp, services too. Yes, there have been some bumps along the way, but it's been an amazing period. And it obviously, although Catherine means it probably, she says she's always suspicious of a sentence that begins obviously, but I will go. I'll say self-evident in that case. Mature economies like the UK haven't been insulated from these developments. On the contrary, they've been deeply integrated into the expanding global economy, albeit in different ways. And the US has been the leader on the tech revolution. It's regained its primacy in energy thanks to the application of tech to fracking. Germany became a leader in high-end manufacturing, and so on. And the UK, of course, hasn't been a global backmarker either, and not just because an awful lot of our industry is multinational or foreign-owned. We were very much at the top end of tradable services and finance and business, university and the creative industries, and all the rest of it. Meanwhile, I think perhaps more than any other European country, we took advantage of the availability of low-cost labour, both actual and virtual, and the result has been a strong growth in low-paid, low-skilled jobs, where investment needs are pretty minimal and productivity is both low and sluggish. And that, in a way, is your description of it. The question, I think, the way I would frame the issue for the UK is to ask where, as a largely deindustrialized service-based economy with a long trading history, you were located during this extraordinary period of global economic development. Was the structure of our economy wrong for the times? Or did we fail to exploit our advantages? Have we sometimes managed to shoot ourselves in the foot? And I think the answer is on both fronts here, actually, not just the first. It's not clear to me that we did maximise our opportunity. And the question we need to be asking ourselves is, if not, why not? In his paper, Paul cites the S-wave model as an explanation of why mature economies tend to slow down. That's the idea that technology comes in waves. I actually am not that convinced that it tells us much about the recent past, but more importantly, I just don't think it's predictive. It's true that advances in technology have tended to come in waves, but those waves have just kept on coming, and they're still coming. There's absolutely no sign that human ingenuity has run out of steam. On the contrary, globalization is giving it additional fuel, all those extra brains adding to the sum of human knowledge, global competition as a spur to innovation. And just now, we're on the edge of what is being hailed as a new general purpose technology, advanced artificial intelligence, that could have a completely transformative effect on services and a services-based economy like the UK. And that, to me, is the big question, really. Scientists are dramatically more optimistic about the future than economists. Even aiming off for the hype that always surrounds a new GPT, it does seem to me that AI and other new technologies could offer huge potential for higher productivity, not least in services. They could, in theory, revolutionize the delivery and maybe the funding of the services for which government is responsible, especially health and education. And anyone who's been close to financial firms knows that there is enormous scope for improvement in productivity there through the application of AI. Whether they've been measured properly is another matter, but it definitely is. So the opportunity is there. The challenge for the future is to manage AI in a way that improves economic and social welfare. I don't know what that means in practice, but as a first step, unlocking the necessary investment, both private and public, is likely to depend on agreeing a broad set of internationally compatible standards and regulatory policies. That is, or should be, a job for government, but it's one, as far as I can see, that they are only just beginning to grapple with. The real problems for the future, as in the past, actually, I think, are likely political rather than technical. Growth always means change. Of course, it isn't only mature societies, especially aging democratic ones, that struggle with adapting to change. But aged infrastructure is costly to update, like wealth and inequality, vested interests, lobby groups, and maybe political dysfunction tend to be accretive. In short, mature societies tend to face serious political barriers to growth, and Liz Truss was not wrong about that. The trouble is that these barriers aren't easily swept aside. Paul has a point when he suggests that they shouldn't be, or not always. Some specific special interest groups reflect deep-seated societal preferences. Others are speaking up for a future that some of us will not live to see. For example, many economists talk glibly about liberalizing the planning system, as if that were a new idea. It isn't. There have been several attempts to reform the system to facilitate major infrastructure projects, but planning hurdles, broadly defined, are still a significant reason why major projects like HS2 and Heathrow's third runway have struggled to progress in a timely way and at acceptable cost. People care about the environment, the landscape, air quality, and they disagree profoundly about what price they're prepared to pay to protect them in the interests of greater mobility and higher GDP. Managing trade-offs and externalities like this and persuading people to live with the consequences is a huge political challenge. Politicians like to say in private, we know what needs to be done, we just don't know how to get elected once we've done it. I find that exasperating, particularly exasperating because, of course, it's true. The test of a political system is whether these difficult issues can be confronted honestly and managed successfully. If not, well, sometimes successful economic change requires institutional and even political reform. Which brings me to the second question I want to talk about. Where should government focus its own efforts in promoting investment? And what kind of institutional reform might enable it to do a better job? It's hard to disagree with the proposition that better governance and strategy around significant investment projects would go a long way to improve performance. But as far as its own investment portfolio is concerned, central government has been struggling with this for at least a couple of decades. There's been an extensive literature on past failures since the late 1980s, at least 1990s. And there were major central initiatives way back when I was the permanent secretary in charge of these things. Paul's paper, and I encourage you to read it, is a good summary of what needs to happen. The real question, though, to my mind, is why is this still a key issue? Are there still perverse incentives inherent in the fiscal rules? I think there probably are. How does the public expenditure control system work in practice? I'm sure the Treasury is still exercising a fairly malign influence on the way that capital spending actually is carried out in government. There's a lot to get onto there. As far as the climate for private investment is concerned, well, I think it's all been said earlier on. I mean, public, the policy uncertainty has been a huge issue in the UK for most of the last decade, really. Any business will tell you that what matters for private investment is a climate, clarity, consistency, and macroeconomic stability. But let me turn, therefore, to, and we know all that, it's just incredibly difficult to deliver. Turning to investment in infrastructure, much of which, of course, in the UK is provided by the private sector rather than the public sector, the government has another kind of indispensable role to play in setting the legislative, policy and regulatory framework, as well, of course, as through its own tax and spending decisions. I was a bit disappointed that Paul didn't have anything to say about this, and I wasn't clear why. The UK's failings in this area have been extensively documented over the years, and they're experienced every day. Our future productivity depends critically on making the right long-term investments in infrastructure. I don't think that's a very controversial statement. So the need for a long-term strategic joined-up approach to infrastructure has been endlessly discussed in commissions and inquiries like this one. The core issue is clear. In areas where long time horizons require sustained political commitment, governments are faced with short-term political incentives that are almost entirely perverse. There is a real need to find ways of building a political consensus that will give investors the confidence to take long-term decisions. There's been some progress in developing a new approach, though of a rather stately kind. Following the Armit review in 2013, which I think was originally a Labour Party initiative, we seem to be close to cross-party agreement on what needed to be done by 2015, and then in 2017, the NIC was finally set up as an executive agency of the Treasury under the chairmanship of John Armit himself. Since then, the Commission has been commendably active. It published a second National Infrastructure Assessment only a few weeks ago, but to remarkably little fanfare. But it's a good document, and it reflected a huge amount of detailed work and wide consultation over the full range of long-term infrastructure needs, including transport, digital networks, the transition to a low-carbon economy, and improved resilience to the environment and other shocks. In response to the first such assessment, the government did publish its own infrastructure strategy, Fairer, Faster, Greener, in 2020. And the Commission now publishes annual monitoring reports commenting on the government's progress in implementing its strategy. Inevitably, there have been more words than action. The Commission's latest progress report draws attention to what it delicately calls a significant gap between long-term ambition and current performance. But it's helpfully specific about where there have been shortfalls and spells out very clearly what needs to happen to get back on track. So there's still a fair way to go, but I think it's not too soon to write a monitoring report on the Commission itself. Has it been a success? And if not, why not? And how might it be improved? Does it need more independence from HMT? Or would that actually just increase the risks of irrelevance? I think it's a debate worth having. But the more important point, to my mind, is that the National Infrastructure Commission has made a credible start. It should be the basis for any new government's approach to infrastructure. And there have been several other bodies that have been set up over the past decade, usually under the coalition government, to address various well-understood challenges in UK investment performance. Take the British Business Bank, and the Green Investment Bank. So I think the point I wanted to make really here is before this commission recommends any more technocratic or business-led groups, we need to critically review the strengths and weaknesses of those bodies we already have. They're very different from the Bank of England or even the OBR, both of which were primarily set up to bolster the UK's credibility in financial markets. Trying to build a long-term cross-party consensus for investment in the UK is an altogether different job, and it's particularly important for investments in something as politically charged as many infrastructure projects. It takes time, it takes effort and consistent political support to build any new institution. We need to understand what works in the UK's very short-termist, often highly polarised political culture, as well as what works in other more consensual countries. Never underestimate also the value of the Bank of England's 300-year existence for the credibility of the NPC. There's a natural deference to anything that's been around that long. Other bodies have a lot of brand building and learning to do. Chopping and changing really doesn't help. So I think we should just be building on what works. Thank you.
Thank you, everyone. We've had two fantastic papers, two equally fantastic discussions. One thing that should be clear from all of this is that the Productivity Commission here at NIESR works as a safe space where people can throw up whatever opinions they have, and without thinking that we have to have a particular Productivity Commission view. Just wanted to make that point clear. That said, of course, I agree with absolutely everything that's been said so far today. I'm going to take questions in batches of 3, and I've got 2 over here and one over there. So I'll start here. I've got to hand over the microphone.
Yeah. Hello. Yeah. Bernard Casey. Thanks for NIESR for this. Thank you for the contributors. I have seldom felt so encouraged sitting in the room, even if the story was often rather a dismal one. At least it encouraged my pessimism. So thank you, all of you. I'm going to comment only on one of the papers, and actually it's the very first one, and it is a bit sort of detail, but it comes back to Catherine Mann's question of concentration. Not very long ago, I read, and I think it's very new, a paper from the Competition and Markets Authority about concentration in the UK labour market, but it was looking at the role of concentrated job hirers, employers by occupations and localities. And one of the points that it made was that there was, this is something which is very different from when I was in kind of a PhD student and we were worried about union markups. It was actually interested in a kind of effectively a markdown and trying to measure markdowns based upon concentration. Now, this actually did start to look at one of the implications of concentration. The only thing I would say, I don't know whether Catherine has read this, but I did find it a very interesting presentation indeed. It does say a little bit about this question of concentration, which was left as a bit of a question mark for you. But thank you all of you very much.
I'd like to hear what our speakers today think of the current idea to deregulate finance and make it more competitive. For example, Ros Altman's current private members bill, for which I think investment companies have been campaigning.
Hi, thank you. I've got 2 questions. One is for Rachel. Just interested in your views. Do you think that there is an issue in the UK around how decisions are being made for infrastructure centrally versus in regions? I've never quite understood why here in London we're making decisions about a hospital in Leeds. It doesn't work like that in the United States. I know it's very different, but it's a much more decentralized decision-making process. And I think this probably plays into the political debate about devolution. So just high-level comments on that. And then I'd be interested also to hear both from Paul and from Rachel on your views around reforms to the fiscal framework. Because again, it's about improving what we have. I think the fact that the UK has the OBR is just fantastic. That we have this independent institutional structure. It's something other countries have after the GFC been set up, but it's in its infancy. So, we don't want to, throw the baby out with the bathwater. What can we do to make it work better? Thank you.
I'm going to go against my four questions.
Hi, thank you. I was just wondering, obviously, you sort of spoke about productivity going back decades and decades, but since Brexit, since the pandemic, we've seen labour costs rise a lot, especially for these sort of lower paid roles. I was just wondering if you think that might lead to productivity gains. We've seen that I think wages are up something like 20% in the past 2 years, so that's quite significant.
Okay, two questions about
So I think in terms of the research agenda, there are three different elements of concentration that are worthy of examination. There's concentration at the investor level, there's concentration at the product level, and there's concentration in labor markets, and all three of them interact to affect the cost of capital, the profitability of undertaking investments, and so, worthy of research on all three dimensions. I can't say which one is, going to be most important. So it's, it's a research agenda. I'll respond to the labor cost productivity. So we can take, it goes back to labor costs rising is not the only factor affecting an investment decision, which may or may not yield a productivity gain, right? So there are a couple of different links in the analysis and the decision making across firms and investors as to whether or not labor costs rising is associated with investment to replace labor or investment to complement labor to increase their productivity. So, it's tough to answer that question, especially in an environment where there is so much uncertainty about prospects for the environment in which a firm may be able to either sell their product or service, right?
Let me use this. Some good questions there. Starting with the competition ones, yes, I sit on the advisory board at the Centre for Competition Policy at the University of Pennsylvania, as well as the other things I do. And they do great work, but it's mostly around things like health and energy supply, so micro, if you like, rather than macro. The UK is an incredibly uncompetitive country. In almost every sector, there is a relatively small number of players who are oligopolists, whether it's transport, communications. Banking actually is in the middle, it's not extreme. And one of the things you get from oligopoly is less innovation than you would expect, less investment, because people are too busy watching each other rather than trying to think. So this is something that should come back very much on the agenda. I'm always very suspicious of the financial sector campaigning for things to be more competitive, because what they really mean is more profitable. By deregulation, they don't really mean more competitive. We could make London more competitive. We are ignoring the competition of London as a financial centre at the moment in terms of policy, as far as I can see. And we need to think hard. That's about things like allowing people to come and work here, encouraging people from all over the world into London to work here, for example, and when actually an awful lot of those workers left after the Brexit referendum. So there's things we need to think hard about in terms of competitive city. I'm not sure I trust the vested interest of those campaigning for it. And sorry, Catherine, you asked some good questions as well. Oh, the fiscal framework, yeah. We do need to think again. I haven't written about that in the paper because I don't actually know all the bits of the fiscal framework that go inside the Treasury. Treasury full of smart people, and I'd like to know more about that before I came up with an alternative. What I do know is our annual budgeting process, as it's presented to the public, is a farce. Right. What's happening at the moment? The OBR said last week, public sector investment is due to fall from 3.5% to 3%. That was the numbers they said. Tax burdens going up. That wasn't how the budget was presented. Yeah. We're not having discussion. What we should be discussing is what share of GDP should the public sector be? Are we happy to pay the taxes to fund them? Are we going to target things like health and education at a certain proportion of GDP? Are we going to pay for it? No, we need to be debating these big questions, not whether we have marginal changes in this tax rate or that tax rate. There's bits and pieces about that. If you want to improve public sector productivity, you need to invest in the public sector. What you don't do is say, we're going to cut your budget and you have to do more with less, because that produces the exact opposite. You always get a worse productivity outcome when you do that, whether it's the health service or any other. I've been on that receiving end of those sort of instructions. Basically, just pass the problem down. Whoever is on the receiving end says, right, well, I'm not going to do that, I'm not going to do that, I'm going to do that, this role, because that's my budget. Oh, well, I'll cut the investment budget because that's the easiest thing I'm going to stop doing. So we need to invest in the public sector, not try and squeeze it if we really want to improve productivity. Or the alternative is to say, we're not going to do it at all. The private sector is going to do it. Let's privatise that aspect of public services. That would be the opposite political view, but we're not doing that either.
Of course, that was a large driver for privatisation, if you go right back, was the sense that investment was very badly managed in the public sector. On your first point about devolution, yes, I think it's very much to the point. If you look at the National Infrastructure Commission's latest monitoring report, that is one of their big points. That needs to be more devolution in decision taking, and also more done to remove barriers to delivery on the ground. The other thing they say is that central government needs to have fewer and larger interventions, less micromanaging everything, more going for the big high value things, and pushing decision taking down the line. That's another area where Groundhog Day sets in. We've known this for a long time, but letting go is incredibly difficult for central government, it turns out, and some of it is about pronouncing. Actually, it's not just political will. On the fiscal rules, yes, I'm sure that, there's two things. I'm not close enough to know what the possibilities for revamping the fiscal rules are, but as I understand it, capital is back inside, isn't it? The latest version of it, which is, again, go back through the years, splitting capital out, being a little bit more imaginative about what is in fact capital. These are really important perennial questions. They certainly need looking at again in my view. How does public spending planning and control work, and does that have a malign effect on the performance of public sector capital? We seem to have moved away from even 3-year planning of public spending, as I understand it. When was the last time there was a 3-year look at public spending? It's 2021, 2022. There's not going to be another one until 2025. There needs to be a reset on both these fronts, actually, and I'm sure that would help enormously. It's very much an area where people know what needs to happen to improve the performance on public sector capital. They're just not doing it, and one reason why they're not doing it is the incentives are all wrong, and the incentives operate at the highest sort of level, as well as further down the track. I share Paul's instinctive suspicion of finance people calling for more competition. However, there is enormous scope for loosening things up in the financial sector in a genuine pro-competitive way, and pushing for greater efficiency. Behind the scenes in the financial industry is you can, even the more you look at it, the more you can see how actually a little bit more figure would improve productivity without a lot of regulatory safety prudence and all the things that we love. There's a lot of inefficiency in the way that this is all done nowadays. It really is, starting with the way that money laundering and all that is all those good things, are basically executed. So there is room, but I don't know whether this guy's private members bill is the right way to do it.
She,
all right. I think guys can be female as well these days. I'm often called a guy and I don't take offense.
There was one question on regional stuff as well. But there's quite a lot about that in my paper, because a lot of the Productivity Commission papers are regional policy. What I'm saying is that there's a good case for doing more regionally. I don't think it's the cause of the national productivity slowdown. But yes, there is too much centralisation. There's lots of good papers on that. But I think that needs addressing. So there's a good case for investing in the regions, just not this one.
I don't know if I agree with that.
I wanted to address 2 points. One is around the fiscal framework, because I mean, the point's been made. There's been so many fiscal frameworks over time. It's too easy to game them, particularly this one at the moment, because it's to do with what happens 4 or 5 years hence. So frankly, it's not leading to the right kind of debates around fiscal policy. I don't think there's a clear answer for this. Actually, there was an interesting evidence session back in 2007-8, I think, between the House of Commons Treasury Committee had a question about whether there should be more economic input into fiscal policy, and the problem of accountability, political accountability versus technocratic, if you like, advice. I think there needs to be more flexibility for bodies like the OPR to look at scenarios which go beyond what the government today says in terms of these are our plans and we'll evaluate it and here's some stuff that's happening in terms of the external environment. I think that sort of thing might create the kind of better dynamic that Rachel was calling for, with real debates as to whether investments in infrastructure A or infrastructure B are going to lead to better outcomes. On devolution, totally agree that more devolution is good. Can I just add one thing? We outside Wales and Scotland, well, Northern Ireland is different. Wales and Scotland, there's actually very little knowledge of what you do in terms of the relationship between central fiscal policy and devolved fiscal policy once you start having serious devolution and serious functions devolved, because then you have real issues around things like block grant adjustments and the way in which that moves relative to local fiscal decisions. I think before England goes on this journey, you need to look at some of this, because actually it's going to be an important part. Understanding the dynamic between local and central fiscal decisions is something we in the UK know very little about, unlike many other OECD countries where this has been done much better. And I think there's some real issues there to make sure, again, we don't lead to biases in terms of underinvestment in infrastructure. So just that's another point I would end.
I should say, I think music in my ears, that's the fiscal framework. We have a book at the back there towards the new fiscal framework that NIESR put together a few years back. And many of the ideas we've heard absolutely in that book. So I'd highly recommend it. Okay, I have a question at the back, and then I'll take the two in the middle.
Thank you. I'm Mary Drzewski, foreign correspondent. I'm absolutely astonished that we've arrived at this point in the discussion, and we had to wait for Rachel Lomax's presentation before anybody mentioned the issue of low-cost labour, which it doesn't feature in the paper at all. It didn't feature in Catherine's presentation, and yet it surely has a bearing on business investment decisions. It surely has a bearing on standard of living, and yet it was not mentioned at all. That also plays into the issue of regulation, because regulation is pretty bad, as Rachel Lomax mentioned, in the UK, and regulation of labour laws is particularly bad. And so when you're making international comparisons, you said, well, really, the UK is not that much of an outlier. And then your biggest comparison was with the US, which you could argue is to an extent an outlier compared with, say, Europe, in terms of labour regulation and the use of cheap labour and imported labour, which is a word that I don't think was mentioned by anybody.
John Mills. I think there is an overarching explanation for why the economy has done so badly over the last decade. And that is that for a lot of this period, we've charged out both our goods and services at too high a price in relation to world demand. In 1950, a quarter, 25% of all manufactured goods were sold overseas, came from British factories. Now that figure is less than 2%, a fall of nearly 95% in relative terms. And the result of all this is that investment has been uneconomical in this country. Has fallen to the bottom of the sea. On a short-term basis, we've had recurrent balance of payment problems that have gone on year after year. And I think the problem we've got is that as long as we go on charging the goods and services we produce out at these overpriced levels, we're never going to get the growth rate up. We're going to finish up like Italy and Japan with growth rates of extremely as far as we can see. So my take on what we've heard so far this morning is unless something is done about the exchange rate policy and what we do charge out our goods and services to the rest of the world, we'll never get on top of these problems that we've got. Because concentrating on the supply side is not enough. You've got to get the demand side right as well.
Thank you, Philip Pagado from Matt. Great presentations, and also I wholeheartedly agree with Rachel and Paul's point about measuring well-being. We definitely need different measures, better measures. It's a whole separate conversation, and I'm more than happy to be involved in that, but there is definitely a lot of activities going on. My question was more about, there is a kind of well-known theory about productivity, which is comes from innovation. Innovation comes from ideas. Ideas come from people, from brains. And do we think, and a question both for all the panel, but for Rachel and Paul, that are we running out of ideas? The famous kind of Gordon kind of theory that we run out of ideas, therefore kind of they're all done now, so now we're kind of going to stagnant. I'm provocative here necessarily, but also we're also running out of people because of there is decline in demographic fertility, but also decline in labor participation and potential decline of migration, and therefore kind of people coming together because we are less integrated as well. So those could be potentially kind of drag on productivity. And if that's a drags, what do we need to do actually to get more ideas out there, more people actually together?
Richard Hayes, ONS. I produce our productivity statistics, so I get to be quarterly the prophet of bad news. And because of that, I'm very sympathetic to what Chris has in his paper, and we've been looking at bringing together wider metrics which better account for human capital, natural capital, and the intangibles which we exclude from the national accounts. And we'll be publishing more of these inclusive income data in April. But like Chris, I think I started that journey as an optimist. We thought that when we put those flows into a measure, we would see improvements over and above what you see in GDP. But what we actually see is since the great financial crisis, a weakening of the growth rate in those metrics compared to GDP. And I wondered whether you have any thoughts on that.
I'm really sorry. We'll have one more question from Bart, and I think we'll call this the final round. I have had the pleasure as a commissioner to think about these papers for longer than many people in the audience, and thank you both to Paul and to Catherine for sharing these papers. The thing that's sort of over the past couple of months, particularly since Paul's paper, I've been thinking about is the root cause. And as he knows, I've said I'm not sure we should be looking for a root cause because I do believe in the productivity puzzle as having lots of different issues. But nevertheless, I want to entertain the thought. And when I was listening around it this morning and even in this discussion, it seems the root cause is concentration, lack of competition. Somewhere in the UK, more than in other countries, somewhere in the UK has left behind this idea of being a nation of shopkeepers to being a nation of vested interest in a limited number of hands. At the same time, we see a country that is hugely fragmented. One of the things that I figured out in the last few years that are going around here, there is no shortage in this country of initiatives, of things that are going on at the local and a regional level, but it's hugely fragmented and not joined up. So the question I think I have to all for you is how do we
maybe one question is, how do we end up in this situation of being a highly concentrated, non-competitive economy with a huge amount of fragmentation? But the bigger question, how do we get out of this? Because if that's the root cause, we have something to really work on.
Huge question. So we'll go from the other way around.
I do the easy one. So we're very concentrated. That's partly about competition policy, which has gone backwards in recent years, and leaving the EU doesn't help. I think that's part of the case for the EU was more competition and a wider market and all the rest. So that's part of the answer. And what was the other thing you said? Yeah, so I think I know the thought I'm searching for there is we're a very centralized country, and I think we've had the last few years in particular has been incredibly difficult. I mean, it doesn't work very well without central leadership. If you're going to have a highly centralized country, you need to have, focused central leadership. The sort of leadership that we haven't had in the last few years, we've had an enormous amount of ministerial churn, and at the level of junior ministers in particular, it's been quite eye-stretching. I mean, just look at it on the parliamentary website. It's just amazing. This is the level at which national initiatives get led, not Chancellors of the Exchequer, but the junior ministers in the Department of Transport. And that's the area where, I think there's been a real weakness in the last. I mean, it's sort of consequence of the enormous political distraction of the last few years and the churning and political instability at the top level that there's been. But I think a sort of unsung cost of all this has been ministerial churn at the sort of workaday level of ministers, which I think makes it very difficult to pull together the sort of national initiatives which, central government, for good or ill, used to do. And so you then fall back on and not, a very incoherent level of devolution, particularly in England. Where it's a complete patchwork at the moment. And, maybe in Manchester or in London is one thing, but in other parts of the country, it's still very, very faltering. And so I just think we've got a very incoherent leadership structure in recent years for political reasons, as well as structural, sort of constitutional type reasons.
Yeah, thanks. There were a number of statements around which weren't really questions. I think, how do we get out of this? We have to focus. We have to focus on what's happening now and where we're going forward. So we need to focus particularly on the infrastructure as it relates to the digital economy. Should we really be encouraging transport, or should we be encouraging better digital communications? People don't have to travel so much. That would be good. Mm-hmm. I think that is key. Going forwards, it's no good going back to all the manufacturing exports we used to have. We're not going to go back to big major manufacturing exporter. The value added in services exports now is much bigger than the manufacturing. It's things like architecture, education. We export. Nearly all the people I teach are from other countries online. We need to invest in those sorts of networks so that we can get exports of services. That's where our value added is. That's what will determine our real exchange rate. It's perfectly true that the higher your productivity, then the higher real exchange rate you can have, and the richer a country you can be. Countries in the Middle East are going to suffer a big problem over the next 30 years as oil disappears off the agenda. Their exchange rate pegs will end up falling off the plot. So this all matters a great deal. I do think, I'm not sure whether the competition story and fragmentation are the root cause or the consequence of what's happening in the economy. I honestly don't know. I suspect to a certain extent the lack of competition comes with the lack of growth rather than the other way around. But certainly we ought to have a more competitive economy. I think the process of growth is one in which governments need to be facilitating change, encouraging new businesses, new industries, whilst protecting people who suffer from the demise of the old ones. Right? What they shouldn't do is be tending to the vested interests of the large existing corporations who are under threat from those new technologies. and you happen to have very large political donations, whether that's unions or corporates, to be politically neutral. We need to be moving forward and thinking about people in the future rather than these big power bases of the past.
So I'm going to have a go at Bart's question, which is, I think there is a political economy angle to this in the UK. I think it's part, as Rachel said, we have a very centralized decision-making process. We've had huge agglomeration economies. You look at the OECD data, shows very clearly second-tier cities, second-tier regions do not do as well in the UK as what happens in other European neighbours. Instead of that then leading to, serious regional policy or serious devolution, which might have led to serious regional policy, we didn't decentralise in the UK, except in one or two cases, Scotland and Wales. But actually, look at Scotland. I mean, a lot of that was devolve and forget. It wasn't, we're going to try and create more joint effort across central government and regional government. We are going to say some of these things are devolved out to the periphery, and when and that has led actually to some not very coherent policy across those two. Now, it may even have led actually to Brexit, because you look at the studies from the LSE elsewhere showing that there's these regional differences, these divisions that perhaps also led to decisions like Brexit and the kind of divisions we've seen before. Now, in that sort of circumstance, I think the only way you're going to heal this is actually through a genuine debate about some of these issues around devolution, but not devolution in the sense of, we're going to take some decisions here in some sectors, or, education or health, you're going to take them all over there. It's about actually much more collaboration, because, again, as I say, the lessons of a competitive devolution model from Scotland and Wales is that doesn't always necessarily lead to an optimal result either. So I would like to see some reforms in that direction in the next decade. If regional devolution comes to England, but I'd like it to see it done a bit differently, I think, than the way we've done it in the nations.
So there really are a range of questions here. I'm going to sort of finish by pointing at the productivity question through two different lenses. One is that global integration is productivity enhancing. It increases economic well-being. There's higher market size. There's cheaper prices. There's more investment. There's greater competition. So global integration is a win across the board, except there are losers. What domestic policy has failed to do is to take the terrific gains that one gets and distributes them appropriately. So it's not a failure of globalization to enhance productivity growth. It is a failure on the domestic side. And we've heard a lot of different challenges for domestic policy to achieve that goal. The second point, though, on productivity is it about the ideas in innovation, or is it about diffusion of existing ideas and innovation broadly through an economy? It's never either or. We would like to have both ideas that push out the frontier, and we'd like to have diffusion across all kind of parts of the economy. Based on the type of work that my teams did at the OECD, diffusion is a pretty powerful driver of productivity. Making sure that diffusion happens, however, is challenging for exactly the same reason that enhanced globalization or global integration is. There are going to be some losers, and what do you do about that? But having, an economy full of domestic zombies is really not a recipe for overall economic well-being for anyone in the population.
And on that note, which I agree with entirely, I have to say, I'd like to thank all of our speakers today. I'd like to thank everyone in the audience. There were some really interesting questions there. I'm glad I wasn't having to answer any of them. And before we finish up with a round of applause. Just to note, there is some lunch in the room next door, so do stay, have a bite to eat, and continue the conversation. But before we do that, thanks once again to all of our speakers. Thank you.